Hello, and welcome to Cost Volume Profit Analysis. I am Dr. Annette Moultrie. So what is cost volume profit analysis? Cost volume profit analysis is a managerial tool, a managerial accounting tool that's used to determine how changes in costs, fixed or variable, sales volume, and price affect a company's profitability. So it helps businesses understand the relationship between their costs, the number of units they sell, and their overall financial performance. So the key components of cost volume profit or CVP analysis is one, selling price per unit. Now that is the amount a company charges for 1 unit of product or a service. The other is variable cost per unit. That is the cost that change with production, such as the raw materials, the direct labor. And we have the fixed costs. Now that is costs that remain constant regardless of production, for example, rent or salaries. The next component is sales volume. Now that's the number of units sold. And last but not least, we have the profit or loss. Of course, that's the financial outcome that is based on those factors that I just mentioned. So you have the selling price per unit, the variable cost per unit, fixed cost, sales volume, and profit or loss. Now, the CVP analysis, it helps business to, one, determine break-even point. Now, we know that's the level of sales needed to cover costs. Then we have the set sales targets. That is how much needs to be sold to achieve a specific profit. Then we have the make pricing decisions. That is understanding how price changes affect profits. And then also we have to assess cost structure. And that is basically balancing fixed and variable costs for profitability. The learning objectives. So the learning objectives of this chapter are: one, determine how changes in volume affect costs. Two, calculate operating income using contribution margin, unit contribution margin, and contribution margin ratio. Three, use cost volume profit with CVP analysis for profit planning. Four, use analysis to perform sensitivity analysis. And five, use CVP analysis to calculate margin of safety, operating leverage, and multi-product break-even points. So let's get into learning objective one, whereas we're going to determine how changes in volume affect costs. So how do costs behave when there is a change in volume? How does cost behave when there is a change in volume? So to make informed business decisions, managers must understand how costs fluctuate with changes in activity levels, such as the number of products produced and sold. So the three key cost categories they need to manage are: one, variable costs, fixed costs, and mixed costs. So what are variable costs? Variable costs, of course, remains constant per unit, but change in total as volume changes. So variable costs fluctuate in total based on changes in activity volume, increasing or decreasing in direct proportion to production or sales level. Now, volume refers to the level of business activity that impacts costs. You have your higher volume, which leads to higher total costs. So, for example, at Smart Touch Learning, the direct materials used to manufactured tablets are a variable cost. Now, each tablet requires what? One battery costing $55. So as the number of tablets produced increases, the total cost of batteries rises proportionally. However, the cost per battery remains constant at $55. Okay? Here in Exhibit 4.1, it illustrates how total variable cost for batteries increase as Smart Touch Learning produces more tablets, ranging from 0 to 100, as you see here. So it's ranging from 0 to 100 units. So if no tablets are produced, there is what? No battery cost, meaning the total variable cost line starts at the origin, which is zero volume, zero cost. So the slope of this line represents the variable cost per unit calculated as the change in total battery cost, which is the vertical axis, divided by the change in tablet production, which is your horizontal axis. So in this case, the slope equals what? $55. $55 per tablet. So when you see in Exhibit 5.1, you'll see that the total battery costs rise proportionally with production. However, the cost per tablet remains constant at $55 regardless of the number of tablets produced. So unlike variable costs, fixed costs remain constant in total over a broad range of activity levels. So some of the common examples include the rent, salaries, property taxes, and depreciation. So in Exhibit 4.2, it illustrates Smart Touch Learning fixed costs for depreciation on its manufacturing plant and equipment. Now, these costs do not fluctuate based on the number of tablets produced. So each month, the company Smart Touch Learning incurs $13,500, as you see here. They incur $13,500 in fixed costs, regardless of whether it produces 0 or 100 tablets. This chart that you see here, it illustrates total fixed costs across different levels of production. Now, while the total fixed cost remains constant, the fixed cost per tablet varies depending on the number of tablets produced. For example, if Smart Touch Learning produces 25 tablets, the fixed cost per tablet is what? $540. Okay? So that's $13,500 total fixed cost divided by 25 tablets. That's how you get your 540. However, if production doubles to 50 tablets, the cost per tablet decreases to $270. So that's the $13,500 divided by 50. That's how you get the 270. So this demonstrates that fixed cost per unit is inversely proportional to production volume, which is as the number of tablet increases, the cost per tablet decreases. Here in this example exhibit, actually, it provides a summary of the characteristics of variable and fixed costs. Again, fixed costs remain constant, whereas variable cost changes proportionately to change in volume. However, with the variable cost, it remains cost constant. Cost per unit remains constant. And the fixed cost, the cost per unit, it changes inversely to change in volume. Mixed costs. Mixed costs. Now, some costs do not fit neatly into either fixed or variable categories. Now, these costs, which contain both fixed and variable components, are known as mixed costs. For example, Smart Touch Learning's sales representative received both a base salary and also commission. So we would consider that the salary is a fixed cost because it remains the same regardless of sales volume. However, the commission is a variable cost since it fluctuates based on the number of tablets sold. So assuming sales representatives earn a monthly salary of $2,000 plus 5% commission per tablet, you see that they would actually have $25. That's the $500 times the 5% commission on sales. Okay, and this exhibit that you see, it illustrates how Smart Touch Learning breaks down total sales representative compensation into fixed and variable components. The $2,000 salary remains constant regardless of the number of tablets sold, making it a what? Fixed cost. Okay? The $25 commission per tablet is a variable cost, increasing proportionally with the number of tablets sold. For instance, if a sales representative sells 25 tablets, the total variable cost is $625, which is 25 times $25. Now, if sales double to 50 tablets, the total variable cost also doubles to $1,250. That is 50 times $25, bringing total compensation of $3,250. So that's your $2,000 salary plus the $1,250. That's how you would get the $3,250. So on this graph, you see that the x-axis represents the number of tablets sold. The y-axis represents total cost in dollars. Now, the total cost line increases from 0, 100 to 500, then you see the 150. The horizontal line extends from 0, 100 to 500, 100, representing fixed costs. The rectangular region below the horizontal line represents fixed costs, while the triangular region above it represents variable costs. High-low method. Now, when businesses have mixed costs, it is useful to separate them into fixed and variable components to support planning and decision-making. Now, one simple way to do this is by using the high-low method, which identifies the highest and lowest levels of activity within a given period. So example of high-low method applied to maintenance costs. So to demonstrate this, the high-low method, let's analyze Smart Touch Learning's manufacturing equipment maintenance costs. So reviewing data for the year, we identify that the highest activity level is what? The third quarter, where they have 480 tablets, right? The high-low method follows 3 steps to estimate fixed and variable maintenance costs for the company, okay? The table below shows the total maintenance cost and number of tablets produced each quarter. First quarter, you see the total maintenance cost was $1,630. The second quarter is $1,935. So you see during the third quarter, you had the highest maintenance cost, and also you had the highest number of tablets produced. So using this data, we can apply the high-low method to separate the fixed and variable components of maintenance cost. So the first step in the high-low method is to determine the highest and lowest activity levels and use them to calculate the variable cost per unit. Highest activity level, you see, is what? During the third quarter, you remember that from the previous screen. That was the highest activity level because they had 480 tablets. And the lowest activity level was during the fourth quarter, where they had 240 tablets. So to find the variable cost per unit, what we would do is that we would calculate the change in total cost and divide it by the change in activity level. Okay? Now, after determining the variable cost per tablet, the next step is to calculate the fixed cost component of the mixed costs. In step 2, we calculate the total fixed cost. Now, this example uses the highest volume and its mixed cost to calculate the total fixed cost. But you can also use the lowest volume and its mixed cost to calculate the same $1,000 total fixed cost. So using the variable cost per unit and the fixed cost per unit, we can determine the total mixed cost at various levels of productivity. So you have the total cost, the total mixed cost, minus total variable cost equal total mixed cost minus variable cost per unit times the number of units. Then you come up with $1,960 minus $2 per tablet times 480 tablets. equal to $1,960 minus $960, and you will have $1,000. Step 3, create and use an equation to show the behavior of a mixed cost. Now, this method provides a rough estimate of fixed and variable costs that can be used for planning purposes. The high and low activity volumes, they become the relevant range, which is discussed in the next section, okay? So managers, they find the high-low method to be quick and also easy, but there are other more complex methods that provide better estimates, okay? Regression analysis for estimating mixed costs. What is regression analysis? It is a statistical method. Regression analysis is a statistical method used to estimate relationships between a dependent variable and one or more independent variables. So we will again look at the high-low method we used earlier in the chapter for total maintenance costs at Smart Touch Learning. Now, I want you to remember that the total maintenance cost, which is the dependent variable, is dependent on the number of tablets produced, which will be your independent variable. Because we only have one independent variable, this is considered a simple linear regression. And here you see on this table, it infers that the highest volume is produced in the third quarter and the lowest volume is produced in the fourth quarter. The highest in the third and the lowest in the fourth quarter. So as with all financial statements in this chapter, you'll see that the following table contains dollar amounts unless otherwise stated. Okay? All right, so step 1 with the regression analysis of maintenance costs. Step 1, you enter the data in an Excel spreadsheet. You enter the number of tablets produced in cell B2, okay, through B5. This is column B, okay? And then in column C through C5, you will have the amount of the maintenance cost, okay? So step 2, you use the slope function to determine the variable cost per unit. In cell B7, you would enter the formula. And the formula is what you see here below. Okay? Whereas in C2, the column C, 2 through 5, they are known as your what? Y-axis amount, which are costs. And B column, the B column, B2 through B5, are known as the X-axis amount, which are the tablets. And then you will format to 2 decimal places. So in the third step, you're going to use the intercept formula or function to determine the fixed costs. So in cell B8, you would enter that formula. Okay, the intercept formula. Whereas in column C, 2 through 5 are the y-axis amount, the costs. Okay. And then you will have to format it to the 2 decimal format. Relevant range and relativity. What exactly is that? The relevant range is the range of volume where total fixed costs remain constant and the variable cost per unit remains constant. To estimate costs, managers need to know the relevant range because total fixed costs can differ from one relevant range to another, and the variable cost per unit can differ in various relevant ranges. Here you see in this exhibit, you see the relevant range. Okay, so that brings us to the end of part one. The end of part one. Please look out for part two, which will cover learning objective 4.2 or learning objective 2.